The financial crisis of 2007-2008, also known as the global financial crisis, is considered by many economists the worst financial crisis since the Great Depression of the 1930s. It resulted in the threat of total collapse of large financial institutions, the bailout of banks by national governments, and downturns in stock markets around the world. In this animation we will discuss the subprime mortgage crisis that led to this global crisis and how risk management can play a key role in preventing such crises. So we have, first, how did the financial crisis start? Solution proposed by the U.S. government. Finally, inefficiency of the solution proposed and how we can prevent a new crisis with efficient financial risk management policy. On September 11, 2001, after the terrorist attack on the Twin Towers, the symbol of the U.S. economy, the crisis began. The U.S. was already slumping into a recession after the dot-com bubble had burst. In spring 2001, the Federal Reserve started lowering interest rates, arriving to 1% in 2003, with the aim to stimulate the economy. And one of the President Bush's solution was the announcement of his new campaign, The American Dream, a home of your own. Low interest rates caused a housing bubble. Cheap loans encouraged people to buy more houses, so housing prices began to rise. The banks granted loans to almost anyone, and that is known as the NINA loan. No income, no assets, no problem. You'll get a loan anyway. Politicians encouraged this phenomena by creating two huge mortgage financing companies, Fannie Mae and Freddie Mac. Their role was to ensure loans for people, and their transactions were guaranteed by the government. There was a huge moral hazard to home buyers, plus no restriction or down payment to people who want to borrow money. On the other hand, the depositors don't care what the banks do with their money because they know the government guarantees it. The investment banks take profit of this situation and make riskier loans. They had started repackaging loans and selling them all around the world as securities. Finally, to develop moral hazard, the rating agencies rate securities as AAA. That's mean the security is very safe. In 2006, interest rates returned to normal levels. People could no longer get new loans to pay off the old ones. As rating agencies removed the higher ratings from the securities, the price of houses declined dramatically. The bankruptcy of investment banks, like Bear Stearns and Lehman Brothers, burst the real estate bubble and announced the big crisis. The federal government would put up $700 billion on the line to purchase troubled assets. The U.S. government wants to spend huge amounts on Wall Street banks to cover their bad deals. Around the world, politicians do the same to save their banks. Also, the U.S. Federal Reserve reduces interest rates to practically zero to restore investor confidence. In 2009, the president approves a stimulus package worth $787 billion to save the U.S. economy and bail out U.S. auto industry. The bailout was necessary in certain regards, but in many cases the government wasted a lot of money because no criteria established as to who would get the money and who wouldn't get the money. In addition, what they could and couldn't do with the money. The decrease in interest rates recreated somehow the same condition of 2001 that led us to here. Finally, accumulation of debt, and this debt is a result of many factors. First, the too big stimulus package. Second, the donation made by Fannie Mae and Freddie Mac to politicians in Washington estimated over $200 million. The only solution to prevent a new crisis is to create an efficient risk management policy that can alleviate the size of the crisis and coping with its consequence. First, reforming credit rating agencies. One step we can do this is to create a supervisory agency that ensure that the rating is objective and transparent to prevent any kind of corruption that happened, for example, in 2007 subprime crisis. Second, introducing a leverage ratio that is intended to put a floor under the buildup of leverage in the banking sector. Third, protecting the banking sector from periods of excess credit growth. And one method to do this is to enforce banks to conduct stress tests that include widening credit spreads in recessionary scenarios. And these stress tests should be made via official agency or central banks. Fourth, introducing a global minimum liquidity standard for internationally active banks. Fifth, the banks should create adequate capital buffers to ensure that they can cover losses effectively during a crisis. Sixth, free flow of credit information among banks and transparency of financial products offered by banks to potential consumers should be ensured by the state. In addition, central banks should play a bigger role in the supervisory framework and create a macroprudential policies. Finally, the state can also promote good financial infrastructure and financial tools to prevent crisis or deal with it. Many prevention and policies can be added to this list, so the right combination among knowledge from rating agencies, protection, creating capital buffer, insurance can alleviate crisis, but one main thing that cannot be controlled is the recklessness and greed in the human nature that urge investors and traders to take tremendous risk to achieve greater profit and gain. Thank you for your time and attention, and I hope you enjoyed the animation.